participation as active members in the California Association of Business Brokers, the International Association of Business Brokers, and the Mergers and Acquisitions Source. Andrew is an expert in business acquisitions and sales for the past 26 and a half years. He's a 5-time successful business owner, an author of 4 business books. He's also a fabulous speaker. And his charming Australian accent will help make this experience even greater. So just procedurally, if you have any questions during the show, please enter them in the question bar on the bottom, and we'll try to answer them during the show. So Andrew, could you please introduce yourself to the audience and give the audience some further details about yourself?
Steve, thanks for inviting me to the show today.
My pleasure.
My accent gives me away, so I'm grateful that you explained where I come from, because I often get asked the question, what part of England are you from? And for an Australian to be asked what part of England they're from, it doesn't sit well. So I'm glad you warned the audience in advance. So thank you for doing that.
Sure.
I'm Andrew Rogerson. As Steve mentioned, I've owned 5 businesses, 2 in Australia and 3 here in California. And I really enjoy the process, having owned businesses, and my family, my grandfather helped my uncles in Australia start Kenworth trucks after World War II. So there's an entrepreneurial flair in the family, and I've lucky to pick up a bit of the gene. So again, Steve, thanks for inviting me, and appreciate being able to share with you today.
Well, thank you. Okay. So the topic today, which was suggested by Andrew, is what to know when buying or selling a business in California. And needless to say, I find this to be a very interesting topic. And Andrew, are you suggesting selling or buying a business is different in California than other states?
Thanks, Steve. Yeah, I do see it different. I've been living in California for the last 28 years. And so therefore, I've been a business broker for the last 18 years. And I attend the conferences that you mentioned, Steve, with the IBBA and M&A Source, and they're always out of state. For some reason, they don't like coming to California. So I'm typically traveling to Texas, and early this year, we had one in Florida, and been on the East Coast and in Denver, et cetera, et cetera. And so it's interesting for me, and part of the reason why I focus on California is because California has different rules and regulations. Just to give you a couple of examples, a lot of businesses in the construction industry, or almost, actually, in fact, to be in the construction industry in California, you have to have a license with the California Contractor State License Board. So if you want to buy a business and you're from Texas or Florida or New York or wherever, and the business is here in California, it takes time for the buyer to qualify to get the necessary license. And often it's a hindrance for the buyer to even be bothered to go through the process, because it can have a negative outcome. Part of the work I do, I value and sell medical practices, and the owner of a medical practice in California has to be licensed with the California Medical Board. So there's a second example, and we have all these different local regulations. Steve, you'd be familiar with health permits for a restaurant, or a liquor license. I think they're probably one of the banes of your life. So you see things that are different in your industry. So yeah, California has a different way of doing things. And I keep hearing everybody saying, it's a good reason to leave California, but there's people that enjoy being here. I wouldn't live anywhere else in America than California. So I'm a California fan.
Got it. I got it. So true, in the restaurant industry, as Andrew had mentioned, we do have our own challenges in addition to the licensing of alcoholic beverage control transfers, and also dealing with the health department. And in San Francisco, if you want to have live music, DJs or karaoke, you got to get an entertainment license, which is very difficult. And then in some cases, you got to get a conditional use permit if you're changing hours and conditions on, different licensing. But, just as a whole, since Andrew had mentioned it to me, and so I had prepared myself to respond, was, what are the biggest challenges in the restaurant industry? And I think without a doubt, it's landlords, number one. Number two, getting good employees. We're finding now that unfortunately, operators having had such a hard time getting employees that they're cutting back days and hours of operation because they don't have enough people to staff the restaurants. And then again, one of the biggest challenges they're having is continuing to provide price value to their customers, because prices are far exceeding of food and beverage products and utilities, insurance are far exceeding their ability to increase prices. Because if they increase prices, per their increases, they're going to alienate their customer base. So they have to maintain this price value situation. And consequently, what's happening is, their margins are getting really nicked, and it's very unfortunate. So anyway, since you prepped me on that question, I thought I'd at least get my 2 cents out.
Steve, that's really good, because what you've shared is it reinforces my point that imagine if I was trying to sell a business right through the 50 states. The intricacies you have with your business, that's your expertise. And, a buyer of a restaurant needs your expertise to help them successfully buy the restaurant and continue. And that's part of my point, that these layers of bureaucracy, they're frustrating when you're buying and selling a business, but it is what it is. You can't fight City Hall, as they say. So the best you can do is learn how to communicate with City Hall and get things done so that the transaction can get closed and the seller moves on and the buyer gets on with their future.
Sure. So you do think California is a difficult state to do business in?
I think it's difficult in terms of some of the license requirements and some of the business requirements. They're not the same in other states. Another example is escrow in California. I typically use a third-party escrow company to close the sale of a business. In other states in the US, often they'll use an attorney, and I have had attorneys handle the escrow in a transaction. But as much as I enjoy working with attorneys, the escrow companies I find way more efficient because they're licensed in California, so they therefore to carry a lot to do the work in California, that they have to know what they're doing, and they build the expertise that really helps. Again, it just helps in the transaction when you've got so many things in play. You've got a buyer and seller that want to get the deal done, but you've got, as you mentioned, Steve, you've got landlords, you've got an SBA lender, you've got an escrow company, you've got attorneys that want to twiddle with legal agreements, you've got accountants that want to give parties advice on taxes. You've got all these moving pieces. And so California has a way of doing things. And if you bring the team around you, which is what my approach is, I'm not the only person in the transaction. I bring in the skill sets to help me get the deal done. And California has its requirements. If they've got the expertise, bring them into the transaction. Let's help the buyer and seller, because ultimately the closing of the sale is in the buyer, and that's what's bringing the buyer and seller together.
Got it. Yeah, makes sense. So when a seller calls you initially about selling their business, how do you start this whole process?
Well, as you and I just been talking about, there's lots of layers to it. But when somebody initially makes contact with me, I try to keep it into as simple as I can, because if I provide too much information, it's overwhelming. And what really is top of mind with the seller is, I'm thinking of selling the business. And the first question comes to mind is, well, what's your business worth? And that's where I like to spend my first conversation talking about, okay, how is the business value arrived at? And it's typical, it's almost without exception that I talk to a seller, they have an expectation on the value of their business, and it's typically much higher than the market will bear. And in reverse, if I'm talking to a buyer and I have the value of the business worked out, the buyer will tell me in great detail why the business is overpriced. And that's, to me, is that's a good sign, because it means the seller's expectations are too high and the buyer's expectations are too low. So my job is to explain, okay, I think you're both wrong, because part of what typically happens in a transaction is that most buyers need to get finance. And if a buyer needs to get finance, the lender is going to be the party that makes that final decision. And part of their thought process is they want the buyer to be successful repaying the loan. And so to answer your question, my focus is do a valuation for the seller so I can help understand the cash flow that's coming from the business. And then if the business value is acceptable, let's take it to market and let the market decide ultimately what the value of the business is worth.
Yes. With interest rates hiking so dramatically, 5 points plus in the last 12 months,
yes,
how's that impacting your ability to list businesses and sell businesses today?
It's a good question, Steve. To me, I've had a good year. The market's strong. I think there's so much money built up from COVID that the federal government released and the state government supported as well. And the economy, I think, is doing well. It's definitely slowing down. That's the purpose of raising the interest rates so much. But interest rates haven't discouraged a buyer from buying a good business. And again, this is just my opinion, but I think these interest rates where we are now, that's going to be the norm going forward. And so SBA lenders and indeed any lenders that's looking to lend money, they're using those rates to guide their forward processes. And if the business can't service the debt that comes off the current interest rates, then the lender won't support a loan. And that's where the market speaks. You've got your buyer and seller with expectations on the value, but the lender is a third party there to decide whether they'll approve or decline a loan.
Got it. So you mentioned earlier about the need to do a valuation, a business valuation, when a seller approaches you. And why do you do a business valuation? Won't I tell you how much they're willing to pay generally?
No, I'm looking to value the business, and one of the main criteria I do a valuation. It's typically a 19-page report. So it's a report I provide the buyer. I provide the seller, the owner of the business, and it's partly educational. I want the seller to understand how the business valuation comes together, because when they get in negotiations with a buyer and a lender, if there's a lender involved, there's going to be all sorts of questions about the cash flow coming off the business. And the cash flow is critical. That's what really guides the value of a business is the cash flow, because the cash flow allows for the debt to be serviced, and the lender wants obviously to cover the debt, but the lender also wants the borrower to have money to pay for their family expenses, or rent, or whatever expenses they'll feed the family. Plus, there's got to be a buffer if the business has a change of ownership and it dips for some reason. The lender wants to make sure there's enough in reserve for the buyer to get settled, regain their feeding, and continue successfully running the business. So there's all sorts of logic. There's all sorts of disciplines that lenders bring to a transaction, and that's my approach with the valuation. Let me help the seller get an accurate valuation based on the cash flow coming from their ownership of the business, and that will guide the value, which will influence what the buyer is willing to pay and the lender is also willing to lend. Okay.
So how do you value the tax returns in putting together a business valuation?
Yep. When I'm doing a valuation, I typically look at tax returns. It's easy to look at a profit and loss statement, but my preference is to use tax returns for two reasons. The tax returns are what lenders used to decide their lending process. And the reason the lenders use the tax returns is because they will get authorization from the seller or the owner of the business at a point in the transaction, but the lender will actually pull the corporate tax returns of the business down from the IRS website. So that's part of if the lender is an SBA lender, and almost all lending these days for business transactions is SBA, the SBA have a set of rules that the lenders have to follow. And one of those rules is the lender getting a copy of the tax return with the seller's permission from the IRS website. So that's one of the reasons I use tax returns as opposed to a P&L. And the second reason I use tax returns is because typically the tax return is prepared by a third party. So, CPAs and accountants, they've got experience in filing tax returns, and they will be advising the owner of the business, how to pay as little tax as possible. But it's that document that the CPA has looked at, as well as the P&L and the balance sheet and the bank statements and anything, the QuickBooks software. The CPA or the accountant is typically looking at all those moving pieces. And so it provides an extra level of comfort that the tax returns are accurate and the numbers can be relied upon.
Have you ever seen situations where you've had tax returns and they've been tax returns of recurring businesses that you have sold before, a similar industry, and you see that they are questionable, that some of the expenses may be out of line, they just don't line up properly, and perhaps there's a little bit of maybe, let's say, fraudulent activity that underlies these tax returns? Have you seen situations like that, and how do you deal with those situations?
Yep, that's part of the reason for doing the valuation, because it allows me, as part of my process, to interview the owner and to ask questions about add backs. We call them add backs, which feeds into your question. Add backs can be legal and they can be dubious. Some examples of add backs would be officers' compensation. If the owner of the business is paying themselves, absolutely should be doing that. If they can afford to do that, we can add back officers' compensation. If they're paying health insurance, I typically add back health insurance because if the buyer is younger than the seller, the health insurance the seller is paying may be way out of proportion to what the buyer would be paying. So I'll add back health insurance. A seller may be putting money into 401k plans or other health savings accounts for health insurance. So there's other legitimate legal tax benefits that the owner of the business can take. And then you start getting into some of the gray areas. That the owner of the business has children. So sometimes they're paying their children a salary from the business, but the child doesn't work in the business. So that's a question I want to know, because if a child is being paid money and they're not working in the business, that's an add back, and that money then can be used to service debt that the buyer takes on. So family members being paid are examples. And I'll keep this simple, but I've even seen some business owners running their home mortgage through their business and they add it to their tax return. Well, that's not going to work as far as the tax if the IRS came knocking at their door. So I've got to be careful with that, but that's part of the reason for having a conversation with the seller about the tax returns and what's behind them.
Yeah. How about unreported cash? Have you seen situations where there has been a lot of there's a lot of cash in the business, and it's based on expenses being way out of line, where they're reporting all the expenses, not reporting all the income? How do you deal with that kind of situation?
Yeah. If a business is putting cash in the owner's pocket and it's not hitting the tax returns, that's another reason why I use tax returns, because unreported income it doesn't exist. And so I would not take a business to market if the seller said to me, by the way, Andrew, I've got X thousands of dollars in cash that I haven't been reporting. I have an expression that the owner of the business, if they're putting cash in their pocket, they can't add that cash to the transaction and ask for the buyer to pay them for it, because they've got no way to prove that the cash was there. And I also have a second thought that says, Mr. Seller, you've already avoided paying tax on that money. You can't get paid twice. So that's the approach. It's a little black and white, but if I'm bringing integrity to the transaction, which is very important to me, I'm only going to work off the numbers that are on the tax return, and that's the best I can do.
Sure, got it. So how do you calculate the value of a business?
I'm using business valuation jargon, so bear with me. But there's the business valuation I put together. It focuses on an item called SDE, and SDE stands for seller's discretionary earnings. So just like we were talking about the gross revenue and then the expenses to, you may have cost of goods. and then you'll have expenses to run the business. That will give you a net income. And then I take the net income and I apply the add backs that we've been talking about to arrive at the SDE. And the SDE is, in my opinion, is probably one of the most important numbers in the transaction, because it lets the buyer know if they operate the business in a similar manner to the seller, here's how much the seller got to make. And if the buyer has a similar skill set and runs the business as well, here's how much they can expect to make. And a lot of buyers coming with the expectation they're going to improve the business because of the skills that they've got, or a new dynamic they plan to bring. And so they anchor their thoughts on the SDE with the expectation they can actually build the business from there. And that's a reasonable approach for a buyer to say, okay, here's what I can start with, and my plan is to make the business bigger, better, and stronger.
Got it. So I'm sure there are occasions where you use the EBITDA method as well, earnings before interest, taxes, depreciation, amortization. When do you make the decision to use the SDE method of valuation versus using the EBITDA method of valuation?
Yeah, good question. Yeah, EBITDA applies for a larger business. So the primary difference between SDE and EBITDA, it's fairly simple. EBITDA simply means there's a manager in place. So often a business owner that's got a business that's doing, 10, 15, $20 million a year in gross revenue, they may be absentee, but they have a general manager in place. And so EBITDA recognizes that there's a general manager in place, and they're being compensated well for their skill set. But therefore, a business would sell at a higher value because the general manager is making the day-to-day decisions to run the business. And so SDE typically works, or SDE is typically applied when it's an owner-operator, when the business has a third party or a general manager in place. And it can be the owner if the owner is in that capacity with a team around him. But the goal is that EBITDA recognizes the salary of a general manager, and then the business valuation drives off EBITDA, which will bring a higher value than working off SDE.
Got it. So what happens if the business owner also owns the real estate and he wants to sell the real estate with the business? How do you handle that kind of situation?
Good question, and lots of dynamics in place. So the question becomes, does the owner of the business, who also owns the real estate, are they ready to sell both now, or would they prefer to sell the business and then deal with the real estate in 2, 3, 4, 5 years' time, whatever their time horizon is? So that kicks off a set of questions. But your question is a good question, Steve, because one of the important things is that if the owner of the business owns the real estate, what is critical is that they're showing on the P&L and the tax return of the business, they're showing an amount for rent. I've seen a number of times where the owner owns the real estate, and because they own the real estate, they do a separate transaction for the real estate, but they don't recognize a rent expense for the business. So I'm doing the business valuation, and I will ask the owner of the business, what's fair market rent for the business or for the real estate? What would you be in the real estate? How much would you be paying yourself at fair market rent? I bring that expense into the business because I want the business valuation to be accurate.
Yep. Because
if I have no rent, or if the rent's too low or the rent's too high, it will distort the value of the business. And so again, one of the things I've learned, I want to clean that up. So when I arrive at my business valuation, it's accurate. And then I will treat the real estate as a separate transaction, or approach it separately. If the owner of the business wants to sell both the business and the real estate at the same time, that's good, because that's of benefit to a lot of buyers who want to buy the business and buy the real estate. Because when they're getting, if a business is getting an SBA loan, for example, typically it's 10 years. If you buy real estate, the SBA will let you get a loan for 25 years. So when you have a business plus real estate and you combine them, a lot of lenders will even give you a 25-year loan on both, or they will blend the rate depending on the value of the real estate and the business. But if the owner of the business has the real estate and wants to sell both, that's a great transaction for a buyer, and it tends to attract more buyers because they want to build equity from day one in the real estate, as opposed to paying rent and not getting any benefit other than the month-to-month benefit they get from using that piece of real estate.
Yeah, on the real estate, they're paying down principal, so they're actually, so
they're building equity from day one.
Exactly, for sure. Yeah, and the restaurant side,
yes,
it's extremely attractive for the restaurant buyer to buy the real estate too. The problem is that in California, because real estate is so expensive, very few restaurant owners own real estate. I mean, we've done over 1,600 transactions in our history, and only 70 commercial buildings because so few. But on the other hand, I would say we have a sell rate of probably 95% of any listing we get with real estate, because it's an end, and in a lot of cases, buyers will overpay for the real estate to some extent, minimally, because again, they want to control their destiny in the future, and it's unfortunate. A lot of restaurant owners lose their tenure because rents get way out of hand, and they just can't afford to be there. So real estate is very desirable from the restaurant side. So are there things that make a business very unattractive to a buyer? And if so, what are those things?
Well, it's a collection of things. If you have customer concentration, that's one of the issues. I'm actually, fingers crossed, closing the sale of a business next Friday, September 29th.
Good luck.
And we had the business on the market last year, and one of its customers at the time, I think I'm okay saying this, I don't think I'll get in trouble, customers of the business was Twitter. And we had the business lined up, seller ready to go, had a lender ready to go. And then in September, September last year, Mr. Musk announced his change of strategy for Twitter. And the customer the business that was being sold, they provided about, in that year, they provided about 25%, they got 25% of their revenue from Twitter. And the buyer got nervous, the lender got nervous, and the deal fell over because of customer concentration. The lender and the buyer were worried that if Twitter decided to shut things down, which they did, it would have a negative impact on the business. What the lender and the buyer didn't understand was that the business is very well secured with other customers. In actual fact, last year was a record for the business, because they had a lot of work from another customer. But that's just an example where typically I'm looking, one of my questions when I'm doing the business valuation, and the reason I ask the question is, Mr. Seller, what's your customer concentration? Do you have a customer that makes up more than 10 or 15% of the gross revenue of the business each year? If I get a yes to that, if I get an answer yes to that question, that requires me to dig deeper, because a buyer and a lender are nervous that if there's a source of revenue coming from one customer, it's too much, and the customer doesn't like the buyer because the relationship is with the seller, that may kill the deal. And I did a business valuation about 3 weeks ago where there was 5 partners in the business, and they were arguing amongst themselves. They weren't enjoying being in business together, and they wanted to value the business so they could, so a couple of partners could be bought out. When I started my conversation with the owner of with the shareholders, with the owners, I found out the business had 2 customers, and it was doing about $1.5 million a year in gross revenue from 2 customers. And I just had to explain gently to the guys that were wanting to leave, I'm sorry, the business doesn't have a great deal of value because you've got 2 customers, and what buyer, you won't get a lender that's willing to lend money to finance a buyer. And a buyer would be exceptionally nervous that you guys have a relationship, and when you leave, they may take their business elsewhere. So customer concentration is a big deal.
Yeah, I'd just like to add something to that. I had this listing. It was a catering company in Menlo Park, and 90% of their business was Stanford University. And they had a long-term relationship with Stanford, a personal relationship with some of the hierarchies at Stanford. And so when I talked to the the seller before we listed or priced the business. I said, what's the likeliness that a buyer is going to be able to maintain the continuity of this long-term relationship with Stanford? And we both agreed that no, that's not going to happen. Wow. So as such, we basically, instead of valuing it as a going concern, because it was very profitable business, 90% of their business going to Stanford, we had to value it as an asset sale. Yep. Basically, they're buying the kitchen and the equipment and the leasehold improvements and the lease, right, etc. So that is very customer concentration is a very important fact. Any other important things that make a business unattractive to a buyer?
If the business has key employees, a buyer is worried if there's a change of ownership. The key employees have been working with the owner, with the seller, and now there's a new owner. They don't quite feel as loyal to initially. They don't quite feel as loyal to the buyer as they did to the seller. So that can mean that they have second thoughts about staying and working in the business. It can also kick in that the employees thought, well, why didn't the seller of the business tell me he was thinking that he was selling? Because I probably would have bought the business. And so that's a real subtle dynamic, because it's tough for the seller because he's thinking of exiting. He or she's thinking of exiting, and they're probably thinking, should I approach the employees? But they're always worried that if they tell the employee and then the employee tells other employees or tells customers or tells suppliers, it may have a negative impact on the business. And so that's a subtle one, but it's a tough one because be nice for the seller to take the key employees into trust and explain things, but if it's not received well, it can have negative consequences.
Sure. We deal with situations where in a lot of our transactions, we're transferring ABC licenses. Right. And part of the ABC process, you have to post a notice on the window, it's got to be there for at least 30 yes. days. And obviously when you post that notice, the whole world knows that the place right. is being sold. Yep. So what we do, if somebody's buying a going concern and they want to keep the concept, the proprietary items, the menu, the name, et cetera, and the employees, which is one of the most important parts of the business, the way we structure that is we have a meeting before we post the notice. We have a meeting with the buyer, the seller, and the employees, and we have it sort of scripted out between the seller and the buyer to present it in such a way that the buyer is going to be a positive, because in a lot of cases the seller is older, he wants to retire, he's not as progressive. In a lot of cases the buyer is younger, they're progressive, they got a lot of new ideas. In some cases they own other businesses, so there are other opportunities for those employees within the business being sold to maybe expand their opportunities. So we basically present it in a positive vein, and consequently we're fairly successful in all the employees staying and giving the buyer a shot. And in some cases, I sold this market not too long ago. We had a meeting with just the top management first, because they had department managers, and basically the buyer offered every employee and management a 10% plus increase to the salary. So that's obviously was a nice perk as well. Absolutely. But just knowing that there's new blood coming in the business, it can be presented in such a way that creates excitement and will be a mechanism to hopefully maintain the employee base, which is so important.
Steve, that's a really good example, and it touches on something that you asked me earlier. It's like you're talking about the public notice, and again, I'm not sure every state in the US has that requirement, but California does. So yeah. You've helped me reinforce my point that welcome to California. We do things differently here, and I also really like the way you described the positive approach you took, because I think that's critical. When you have something negative or something that could be perceived as negative, you've turned that into a positive, and I think that's one of the skills a good broker brings, that we can take a set of facts and understand them and say, okay, how do we share them, and when do we share them, and these are some of the things that you've learned from your years of experience, and it's part of the fun part of what we do.
Absolutely. Mm-hmm. So Andrew, how do you approach actually taking a business to market? What's involved in that process?
So part of the reason I do the business valuation is that it allows me to ask all these questions and get comfortable with the business. And then I have have two documents I prepare, and I do other documents, but there's two marketing documents I put together. And the first one is called a blind executive summary. And it's just a one-page document. And I build that document because I want to share with the world the business opportunity I've got for sale, but I want to keep almost everything confidential. So it'll have, you know, an industry headline. It'll have a summary of the financial performance of the business at a very high level for the last 4 years, because people, you know, a buyer wants to know how the business has been performing. So my one-page executive summary includes that. It summarizes how many employees. It'll give you an amount for the lease, because buyers want to know what the lease cost is. And there's other data points on there, but again, it's built for the world to see and doesn't share anything confidential. So, for example, you know, I'm selling a business in the Bay Area, and I'll just reference, you know, the East Bay, or I'll choose a broad geography as opposed to a specific town, because there may only be one business in that town, and this could be the business. And so if you name the town, you've immediately given away the business that's for sale. And so I don't want the world knowing that, because it can have really negative effects. It's the employees that find out. We don't want them knowing that there's a change of ownership under most circumstances. But customers may find out and they'll get nervous. The landlord may find out and they may get nervous. And people that provide credit to the business, they may find out as well and say to the owner, to the seller of the business, hey, we're just taking you off credit. You're now on cash. And that could have a negative impact on the business. So the one-page executive summary is important. And then I build a confidential executive summary, or a confidential business review, got different names for it. But I build that document, and it's only released to a seller, only released to a buyer when the buyer has signed a non-disclosure agreement. And we're in California. I also have to present an agency disclosure that I have a real estate license. So I have a non-disclosure agreement available online and an agency disclosure online. The buyer fills those out. They show me they're qualified to buy the business. If they plan to get a loan, I want to understand their financial ability to qualify for a business. And if we're comfortable with all those details, then I'll share the confidential executive summary or the confidential business review, as well as a disclosure statement, as well as a list of fixtures, furniture, and equipment, as well, so that the buyer of the business gets a really good feel for the opportunity and can have a reasonable sense, hey, this is of interest to me. I'd like to talk to the owner. Andrew, can you set up a Zoom call? Because I've got some questions for the owner of the business.
Got it. So what do you see that are the biggest, let's see, turnoffs for a business not closing? And the obstacles that come into
Steve, you'll have you could probably talk for an hour or two, I'm sure, on the different things that have happened to you with the businesses you've tried to sell. But biggest challenges is bringing all the pieces together. This business I plan to close, I hope to close next end of next week. The buyer of the business bought another business, had it all lined up and ready to go, and the landlord said, no, don't feel comfortable, not going to approve a lease. And so he lost the opportunity of buying that business. And that's how he came to my business. So just a young guy, all dressed up and ready to go. And the landlord said, no, not willing to work with you. And so that's just a reality of what it was. And the transaction failed because of it. You're looking at insurance, you're looking at lenders. We were talking about lenders before, Steve, and SBA lenders right now, they're fickle. Just like you said, Steve, interest rates have gone up 5% in a relatively short period of time. And my experience with SBA lenders, and they're challenging because you talk to the people, your initial contact people, they're called a business development officer, and they're on board thinking this is a good deal. But the person with the most at stake is the underwriter. Mm-hmm. And if you can't move the underwriter to a positive place, the loan's not going to get approved. And even if the underwriter's on board, you've got the business development officer and the underwriter on board. A lot of lenders have a loan committee that review the work of the underwriter. And if they're not comfortable, you can't convince them to change their mind, because their role is to protect the the banking services and the lending services of the bank. And so there's a couple of examples. You're dealing with different nuances, again, with California and the license requirements and lenders and landlords and managing the employees as best you can. There's just a few examples of things to navigate.
Right. Have you dealt with situations where during the transaction, you have seller remorse, where the seller thinks twice about selling and he's in contract, or conversely, you have buyer remorse and the buyer's thinking second about moving forward? How do you handle those situations?
Yep, that's part of the joy of what we do, Steve. I know you could probably talk for a day or two on all that, but yes, buyers have buyer's remorse and sellers have buyer's remorse. Even though they're selling, they have buyer's remorse. They just can't quite get there because, again, part of my reason for doing the valuation up front, I'm looking to understand from the seller, what's your reason for selling the business? And if they say to me, well, I'm thinking of selling the business, I want to spend some more time with the grandkids. I tell them, you don't have to sell your business to go and spend more time with the grandkids. You can go and do that now. You have permission. You own the business. You can go and do that. And so, same thing. I want to play golf. It's like, okay, you own the business. You're in charge. You're allowed to take some time off and play golf if that's what's important to you. Don't try and sell the business because of spending time with the grandkids or playing golf. You'll change your mind. It really needs to be a motivating reason why you're selling the business, and equally, it has to be a motivating reason for the buyer. If they're not motivated or they're thinking of buying the business and their heart's not in it, they'll have second thoughts, and that happens all the time. That's the joy of what we do.
Sure. So, from your perspective of wearing two hats, having been a business owner and also a business broker, what's your take on when is the best time? When do you know when it's right to sell?
As far as the seller is concerned, the best time, and I'm being careful with this, but if a seller's got a health issue, that's priority. It's got to be taken care of. And if the business is so stressful or it requires so much that the seller can't take care of health, that's a motivating reason that makes perfect sense. Often divorce comes into decision making, but yeah, it just varies with each person and their priorities. But what's critical to me is, what will the seller do when they sell the business? Are they moving to something that's important to them? Most business owners, they're full of energy. They get great enjoyment from running their business, and it gives them a purpose. And they're not going to sell a business and go and sit on a couch and watch TV. If that's their goal, that's a conversation I'll have with them. It's like if you plan on traveling, again, there's only a certain amount of travel you can do. But if you're at a point where you've lost the motivation to run the business, that's important. You need to sell, because if you don't, the business will drift. And the only direction it will drift is typically lower. And if it goes lower, your business valuation goes down. And if you don't catch it quick enough, it may even be that the business runs out of steam, and you'll lose the investment you've made of all these years of owning and operating your business.
Yeah. How often do you see partnership disputes being a major driver for selling a business?
You see it, and it's quite it's another complication. I got a phone call this week from a guy who owns 33% of the business, and his partner owns the remaining 67%. And he's in an extremely difficult place, because the guy who owns more than 51% of the business, they're in charge, because they get to make binding decisions. And that can be frustrating for a partner, because they thought, at the time they thought, hey, this is a really good idea. I own a third of the business, so therefore, if it's worth $1 million, I own $333,000. Well, it's not quite true, because the market for selling minority shares in the business, there is no market. If you're on the stock exchange, New York Stock Exchange, you're selling shares every, and small numbers of shares every day. But businesses are privately held. There is no place, if you own a third of a business and you're not enjoying working with your majority partner, there's nowhere to go to sell that third, because the only person that would buy it is the guy who owns the 67% in that example. And so minority share ownerships, they're not a great place to be.
For sure. Got it. So how long does it generally take to sell a business?
Well, Steve, you're a member of CAB, and I think you'll be familiar with the metric that we suggest. It's about 8 months to sell a business. But it's, and Steve, you'll know this from your industry. You can talk about the restaurant industry, but only about 20 to 25% of businesses actually sell. The experience we've got is that so many businesses come on the market, and the economy's changing. Things are always in motion in the economy. So the business may be struggling at that point of time because there's, prices have gone up because of new taxes or supply shortages, or, COVID. We saw a whole bunch of things that affected COVID, different businesses in COVID. People weren't getting out, they were staying at home. And so so these things affect the business. Again, I mentioned I sell medical practices. A lot of doctors just struggled through COVID, and it was also the nursing and the hospital administrators. It was so demanding, and so every business can be hit in a different direction, and that's the nature of what we do. And if a business is in an industry that's hurting, it's not attractive to buyers. Buyers see that very easily, and so there's very little interest in buying a business that's going through hurt, and a buyer wants to see it when it's back on the upswing. And I'm sure that's what you see with your restaurant, Steve. Does that make sense?
Oh, absolutely. Yeah. I mean, obviously a business is more desirable when it's making money and it's
Right.
It's doing well. Unfortunately, many of our clients wait too long, and
Yes.
the business is going down. And we're seeing a situation now where, unfortunately, the lifeline for a lot of these restaurants has been the PPP money, which
Right.
they've exhausted, and they're losing money because they can't again offset their increased prices with the menu prices. The market will not allow it, so they're in a very precarious position for
Right.
sure. So for the benefit of the group, why don't you tell them what industries you specialize in and why?
I tend to focus on about 8 industries, and I'm not going to remember all of them, but I like these 8 industries because they go through cycles, but the cycles are generally predictable, and they're in industries that are of interest, typically of interest to a buyer, and they're also of interest to a lender. So I like businesses in the manufacturing sector. I like businesses in the construction industry, even though the construction space is difficult and cyclical. Often a good construction business can do very well. In a brief stint in my life, back in early 2000s, I spent 5 years working at Hewlett Packard, and I got a bit of background in tech. So I enjoy the tech industry. I enjoy industrial services. I enjoy logistics business. California grows about 45% of the agricultural products that are bought in the US. California provides 40% of the agricultural products, and so you've got to find a way to get them from California to New York to Florida to all parts of the US. So logistics are an important part of that, and there's an industry that operates to allow all that to happen. So so there's a few examples. I do have a website. If you go to my website, there's more information on my website about the different industries that I focus on. And I also, as part of my website, I'm doing a bit of a plug, Steve, but I like writing articles about these different industries because they go through cycles. And so you'll see information on my website about the different industries and what's happening. And that's part of my approach to what I do.
Yes, thank you. And by the way, Andrew's website, one of his major website is on underneath the picture here. You can see it. It's rogersonbusinessservices.com. So we had talked earlier in California, we use services such as escrow companies, attorneys, CPAs, and accountants. Can we touch on those? You've mentioned something about them, some of them,
Yep.
but maybe
Yep.
any others you want to talk about, particular dealing with attorneys, dealing with accountants, CPAs, et cetera. I'd like to get your thoughts on those items.
I'll just touch quickly. With attorneys, I'm a member of the Sacramento County Bar Association. So the Bar Association is not a place where you go and have a drink. It's a place where all the attorneys hang out. And it's an association to help attorneys run their law practices. So I'm a member. I'm not an attorney, but I like networking with attorneys because I say this carefully, but I'm trying to work out how these guys think, and it's hard to understand sometimes how they think. But member of the Sacramento County Bar Association, and I'm also a member of Cal CPA. And one of the reasons I'm a member of Cal CPA because when a business owner is selling their business, a typical question that pops up is, Andrew, what are my tax consequences from selling the business? Well, I'm not licensed in California to provide tax advice, but I've got people that I've met, and I'm happy to make an introduction to somebody that can help a business owner sell their business and put some strategies in place to reduce the amount of tax they have to pay. So, so that's the reason I'm involved with the attorneys and the Cal CPA. And then obviously I'm involved with the business broker associations as well. So we stay up to date on the different things that we touch, and that's my approach.
Yeah, in light of that, I know I make a habit of, when I'm talking to a seller, to make sure before he lists the business for sale that he checks what are the tax consequences of the sale, and to see if there's anything he can do to minimize those tax consequences.
Yes.
Unfortunately, when we're selling businesses, FF&E, fixtures and equipment, are a very small portion, usually of the allocation, and it's the only portion that can be, so to speak, you can do a transfer of, a deferment, like in a real estate, a 1031 exchange. You can possibly do that, but that I don't think we've ever done that, and it's so much more trouble than it's worth, and it just it doesn't work out. So it's hard to defer substantially the taxes. The key is to minimize, try to get in the lowest capital gains category as possible, minimize ordinary income, which is twice as much as capital gains, etc. So it's important. The underlying.
I have a tax guy that I work with. His typical focus is the sale of a business over $1 million. His logic is that he can prepare a tax minimization strategy. Mm-hmm. But the value has got to be $1 million and more because of the things that he's doing. He gets his opinion supported by an attorney. So he'll scope out the plan, and then if the seller of the business wants to engage him, he then has an attorney write it up so that if the IRS come and want to know details, why was that tax strategy followed, he's got it supported by an attorney who specializes in doing tax and those sorts of things.
Yeah, I think it's critical because it's obviously, especially if somebody's selling their business for retirement, and they need the amount of dollars to live, and longevity is increasing. So,
absolutely.
If there's an exorbitant amount of money that's taken out for taxes, obviously it's going to affect their lifestyle, and especially if they're in a retirement mode and they don't have other sources of income other than maybe Social Security, et cetera. So, tax planning is very important, to say the least. So I think we've covered the majority of the things that we have talked about. I want to thank you very much, Andrew, for not only your participation today, but for your professionalism, for your contribution to business brokerage community. You've given a lot to that community. You've been a speaker, you've participated in various conferences, et cetera. And I've always enjoyed hearing your input and learning from you, and your commitment to the industry as a whole. So I thank you very much for that.
Thanks, Steve. Appreciate it.
Again, if you want to touch base with Andrew, what's the best phone number to reach you at?
My best phone number is 916-570-2674. Or if you prefer, go to my website. There's a contact us page. You can read some information, and you can fill out the contact form, and that will flow. An email will flow to me, and then I have a marketing person that helps me with the emails that I get. And one of my steps is to have a conversation with the owner or the seller of a business. But I like to get prepared. My marketing guy will send an email ahead, and there'll be a set of questions for the owner to complete. And then I'll schedule a call with you. And I have information about the business, so the marketing guy helps me be prepared. So when I'm talking to the owner of the business, we can focus and get through the questions and go from there.
Thank you. I just noticed there are two questions in the question box. Actually, one from one of my key agents. How many states are you licensed to sell businesses in?
Well, I'm only in California. The size of California, that keeps me way busy. So just California.
Okay. And the next question, living in California, what hurdles do you have to overcome selling businesses out of state?
The trick is that each state's different. So, for example, Texas doesn't have a licensing requirement. So anybody in Texas can set up shingle and say, I'm a business broker.
Yeah, I think there's only 14, excuse me, I think there's only 14 states,
Yep.
Is 14 or 17 states?
I think it's 17. Yep.
Yeah, 17 that require a license to sell
Right.
businesses. Yes,
Yep.
California being one of them.
So, so it's caveat emptor. Let the buyer beware. That's again, being licensed here in California. There's things, Steve, you and I have to meet those requirements to present ourselves to the market as business brokers. So, a lot of US states don't have that requirement.
Yes, absolutely. And I'm thankful that we are licensed, because I think it eliminates a lot of the people that perhaps would not be qualified to be a business intermediary and to properly represent folks. Let me just turn that off. Excuse me. Sorry. Mm-hmm. Okay. Thank you for those questions, by the way.
Yes.
Our October show will feature Michael Baker, who was a client I sold Pizzalina to in San Anselmo. Michael is now under construction for his second unit at Walnut Creek, and Michael's prior experience included executive chef at Chalet Restaurants, which had 5 restaurants doing $21 million in sales. And he was also had executive chef positions at several other fine restaurants in the Bay Area. I will be actually doing show number 2 on the 10 essential principles a buyer needs to know in purchasing a food and beverage business, which I will present on October 12th. Then in November, Jeremy Brockman, our marketing director, will be talking about cutting edge marketing techniques to assure our company continues to be competitive now and in the future. So I want to thank again, Andrew, for your great presentation today and your continued support of the industry. I look forward to seeing you next week at the IBBA conference.
Conference, yeah.
And thank the audience very much for joining us today. And again, if you want to get in touch with me, it's steve@restaurantrealty.com, or our office phone number is 415-945-9701. And once you get the directory, you can just punch a button that leads to me, and I'll be happy to get back to you again. Well, thank you all for joining us. And again, thank you, Andrew.
Thanks, Steve.
Have a good day. Take care.
Thanks.
Thank you.